Good morning, ladies and gentlemen. I hope you had uh, a good night rest, and I hope the training we had yesterday was impactful. Today is yet another day as a continuation of the training. That will last for 4 days. Today, the second day of the training, we are going to look at certain areas, starting with uh, the topic key industry regulators and financial reporting implications. And our facilitator today is Mr. Enola Agbawe. Mr. Enola Agbawe, are you there?
Yes, I am. Yes, I am. Good morning, everyone.
Good morning. I welcome you officially to
Yeah.
our second day of the training. And today you are going to take us through, I think, two topics. This one and, Basel regulations. So without wasting much time, the floor is yours. You may continue, please. Thank you.
Thank you. Thank you, sir. Good one. Good morning, everyone. My name is Eniola Agbaoye. I'm a manager at Anderson. I'll be taking us through today's module, second day of the training, that talks about accounting, governance, and regulations in the financial services industry. Just to give you a bit of background, I have over I have close to 10 years experience servicing financial service industry in terms of accounting and risk management. I've assisted in developing accounting frameworks for several banks in Nigeria and in West Africa. I've assisted with IFRS 9 implementation across West Africa and in countries in Southern Africa. I've also assisted with Basel implementation, Basel gap analysis within Nigeria and across some countries in West Africa. So that's a brief bit of background about my experience. I'll just go straight to the first module for today's training, which talks about key industry regulators and financial reporting implication. Here we have the training objective to say that at the end of today, each of the participants should be able to understand key industry regulators and financial reporting implication. So in your different jurisdictions, you should be able to have an idea of the key industry regulators or players in the financial services industry, and also to be able to understand the framework of the four Basel Accords. Basel Accord is very important for financial services industry. You should identify the key elements of the financial statements, understand the components of financial statements, and understand principles of cost and revenue recognition. During the course of the training, if you have questions, you could drop your questions in the comment or chat box. To the first module for today's training, which talks about key industry regulators and financial reporting implication. Just to give you a bit of background to ask, like, why are we having a conversation or discussion regarding the key industry regulators and financial reporting implication as a tax practitioner? As a tax practitioner, it helps to understand the regulators in a particular industry. This would assist to also understand the behaviors and the reporting framework which these institutions that are part of this particular industry need to report to. For instance, when you're talking about financial services industry, this is one of the most, if not the most regulated industry in Nigeria and West Africa, because You have several regulatory bodies very much interested in these financial institutions. Major reason because they keep people keep their money with them. So obviously, this is very, very fundamental and very important. One of the key industry regulators is the West African Economic and Monetary Union. The acronym is called WEMU. This was created in Dakar as January 1994 and plays a key regulator of the financial institution in West Africa through the Central Bank of West Africa. It comprises of 8 member states of Anglophone countries within the West African region. The specific objective, for creating this particular body, one, to ensure price stability in the sub-region through sound monetary policy, management of foreign exchange reserve, strict banking supervision by the central bank, and act as a common issuer of treasury bills and treasury bonds for all member countries. Currently, this institution is not as strong as it should be because you also have the key. When I go into subsequent slides, you would understand why this WEMU is not as strong as it should be. The member countries that consist of the West African Economic and Monetary Union states, you have Benin, you have Burkina Faso, Ivory Coast, Guinea, Mali, Niger, Senegal, and Togo. Some of which is also part of the part of WATF. Now you also have, pardon my French, because my French is still a bit basic. You also have the Conseil Regional de Valeurs Mobilières, which is the BRVM. This is a key regulator. It began operation in 1998 and serves as the regional stock exchange for 8 member states of the WEMU. So the BRVM is a key regulator which focuses on the stock exchange for these 8 member countries, like I mentioned before. Okay. The key focus for this is corporate bonds, government bonds, then bonds from regional development. They typically are in charge of this. This is followed by the West African Monetary Zone. The West African Monetary Zone, which is called WAMS. So I will be calling it WAMS. It comprises of 6 African states with the dominance of 5 Anglophone countries. The key objective is to regulate financial institutions in West Africa, and its main responsibility is to facilitate the realization of a single monetary union of the WAM. So what this aims at is to have a single currency. So these are the key priorities of WAMS. Create a central bank for West African region, which will be called, or which will be the West African Central Bank. Act as a regional supervisory body, the West African Financial Supervisory Authority, and develop a strong single currency, the ECO, among the member states. I'm aware that this is still an ongoing conversation and this has not been fully implemented. So there's no single currency in West Africa. So these are the member states. You have Gambia, Ghana, Guinea, Liberia, Nigeria, and Sierra Leone. Now, the other key regulators that we have are basically the Apex Bank. So for instance, if you look at each of the countries that are part of WATF, you have Gambia, you have Ghana, you have Guinea, you have Liberia, Mauritania, Nigeria, and Sierra Leone. Each of these countries have a key regulator. They have their central bank. You could also note that for these countries, they also have their Securities and Exchange Commission. Some of these countries are part of WEMU. So based on the fact that they are part of WEMU, BRVM, which is Bourse Regional de Valeurs Mobilières, acts as their SEC. But case in point, in terms of for Ghana and Nigeria in particular, you notice that Ghana has its own central bank, Nigeria has its own central bank, and both Ghana and Nigeria have their um, independent Security and Exchange Commission, which is Nigerian. Which Ghana has its own, and Nigeria has its own Security and Exchange Commission. You could see that even for Nigeria, there are other key regulators for the financial services industry. Now, what this implies in terms of for companies that operate in this particular industry, what you typically on companies that typically operate in this particular industry are banks, mortgage banks, deposit money banks, typically banks in terms of financial services industry. You also have insurance companies. You have a lot of insurance companies. In the last 5 to 10 years, what we've been seeing in this space is fintech companies. We've seen how fintech companies have evolved over the last 5 years in West Africa, where you have payment platform companies, blockchain technology companies. So the fintech space is really, really growing in terms of this financial services industry. Currently, these are the major key players in terms of the financial services industry in West Africa. So you have your banks, which is broken down into the different types of banks. You have your microfinance banks, you have your commercial banks, you have your merchant banks. Then you also have the insurance companies. You also have insurance firms. Depending on the different types of insurance, they do life and non-life insurance. Then you have your fintech companies. These are, in the last 5 years, are now becoming very strong players. We have in Nigeria one or two fintech companies whose assets, in terms of asset size in Nigeria or balance sheet size, would be number 3, which is within the space or span of 5 years, this particular fintech company has grown bigger than banks that have been established in Nigeria for over 40 to 50 years. This speaks to the fast-paced growth of fintech companies in this particular industry. Now, one of the key challenges for players in this industry is the reporting implication. Based on the fact that they report to several regulators, so there's conflict in the diverse regulatory guidance and principles that influence this financial reporting. You have a reporting guideline from CBN, from the central bank. You have a reporting framework or guidance from the Security Exchange Commission. You have like a different guideline from maybe the Code of Corporate Governance. So what we've seen in this space is that based on the different reporting and regulatory guidelines or regulatory principles, this kind of influence their reporting, and you will have some bit of conflict. What has happened in the current 2 to 3 years has been that there has been a convergence in terms of saying that the central bank would say, oh, we are the central bank. As long as you confirm to the center, comply with the central bank, some of these some of your reporting framework and guidelines that are being stipulated by other regulatory authorities can be waived. But what you see is that there's a different financial reporting for the Security Exchange Commission. There are several for the central bank. For instance, you have several regulatory bodies that exist from the WEMU. You have Apex banks of individual countries, which oversees the commercial banking sector, to the SEC, which monitors brokers and stock exchange. This is just giving you an instance of some of the conflicts that arise. So you have instances where WEMU and the Apex banks of these individual countries are overseeing the commercial banking sector. You also have SEC that also monitors the brokers and stock exchange. So this just highlights to say that when you are dealing with financial services industry, their financial reporting is majorly guided by one, International Financial Reporting Standard, which is IFRS. Two, also guided by the regulatory principles from the different bodies. I don't know if there are any comments or questions before we move into the second module.
Okay, yeah, please kindly use the question and answer button to post your question there. Then later on we can address it because we can barely hear you from our end
Yeah,
here. The network is bad. Thank you very much.
that's
Mr. Inola, please go ahead and continue. Sorry about that.
okay. Thank you, Mr. Salisu.
Well, thank you. Mr. Inola, please, the floor is yours.
Okay, thank you. So I'm just trying to set the question box. So we go straight into Basel regulations. Basel regulations is one of the more interesting bits on the financial service industry. There is no how there will be any player in the financial service industry for banks in particular, that you would not talk about Basel. Basel basically is the framework that governs risk management, a bit of financial reporting for banks. There are other regulations that govern for insurance, but for this training, we'll basically be talking about the Basel regulations. So the question is, what is the Basel regulation? The Basel Accord. So in order to understand the Basel regulation, we'll have to go into what the history of the Basel Accord is. Why is it called Basel? Is Basel an acronym for a particular body? So a bit of overview about Basel. The Basel Accord refers to a set of international banking regulations created by the Basel Commission on Bank Supervision. You will see BCBS, which is based in Basel, Switzerland. Now, one of the reasons it's called Basel is that the first time the banks, so I'll give an overview. So maybe when we go into the overview, then we now flow into how Basel came about. But just to state that one of the first meeting that was held in Basel, Switzerland. And based on the fact that it was held in Basel, they decided to call it the Basel Accords. Now, in terms of the Basel Accord, what happened is top management and officials of banks at that point in time was the G10 countries. The G10 countries, I think, consist of US and some other countries. At that time, decided to come and say, look, we need a uniform set of rules that would guide banking operations, banking regulations globally. What Prior to that, what was done was that there were different regulations for different jurisdictions. So a Ghana, for instance, would have its own regulation. A Togo, for instance, would have its own regulation. So there were different regulations for different countries. Then if you go to Europe, they will have their different regulations. So what they needed to do was say, we need to harmonize this regulation, which will even give us a bit of comfort in dealing with banks that are outside our jurisdiction. So the G10 countries came together in Basel, in Switzerland, and came up with the Basel Accords. Now, what happened? What were some of the things that triggered them needing to come together? I've said 2 points. The first being they needed to harmonize in terms of risk management and reporting framework for banks globally. Two, there were different regulations from the different countries and jurisdictions. So some of the problems they identified before coming together was the national regulators were the most important actors in banking practice. This is true. And currently, for most jurisdictions, it is still true. But what Basel has done is that you have a global framework where Basel would come up with a global framework. It is now the duty of the national regulator. Who are the national regulators? The national regulators are the central bank of each country. Now, the national regulators will come up and, based on the Basel framework, adopt it and domesticate it. So let me give you an instance. Basel framework would state that the capital adequacy ratio at a minimum for banks should be 8%. What the capital adequacy ratio is talking about is saying that looking at your capital that you have and the amount and quantifying the risks, your risks in terms of your credit risks, market risks, and operational risks, that can your capital, in case of stress, will your capital be enough to cover your risk? And based on when you do the calculation, Basel prescribes 8%. But you have instances for Nigeria, for instance, where the CBN, the central bank in Nigeria, has said, even though Basel has prescribed 8%, what we are prescribing is 10%, depending on the kind of financial institution you are. But at a minimum, what we are prescribing is 10%. Depending on the kind of financial institution, it can be more. Two, it states that some of the problems identified was the coverage standard was not adequate enough. It wasn't adequate. There was no framework. It was just, rule of thumb. No global regulation for the rise in globalization of banking and financial markets. In this case study, one of the reasons that also triggered this in terms of the problems identified was globalization. You had instances, prior to then, a bank in Nigeria or any country was not doing trade with another bank. But now there's globalization where you are transferring money from anywhere in the world to your accounts. And based on it, they were like, look, the world is getting global. We need to come up with a global regulation. And based on this problem, they were like, there was a need for what is the solution? So it prompted the governors of 10 countries, which is the G10, in 1976 in Basel, to form a Basel Committee on Banking Supervision. So what the regulation is called the Basel Committee on Banking Supervision, the BCBS. Now, which has since then released up to 4 supervisory regulations for financial institutions in terms of banks. So for financial institutions in terms of bank, you have four Basels. So there's Basel 1, there's Basel 2. After Once I go into the different Basels, we'll have a proper understanding of this. So I can see some questions. So the question is like, is there a synergy of actions between APEC countries, Nigeria and Ghana, and UMO member countries? So what I would say is that currently there are conversations ongoing because of the because of how globalization is in play, and in terms of the close borders we share within West Africa, there are ongoing conversations between Nigeria and Ghana and the other member countries. So there are ongoing conversations. But James would provide a bit more perspective on that. Now, some of the major issues that led to the introduction of Accord. So now, based on the different Accord, these were the major issues that I identified. So as the world keeps evolving, and globalization keeps evolving, for instance, we have the fintech companies in the financial services industry space, and there are new issues that are coming up based on new products, new payment platforms, new way of doing trades. The Basel Accords will keep updating and reforming itself so as to meet the fast-growing pace of the industry. Now, the Basel Accord, Basel One. So when I say Basel Accord, which is Basel One was issued in 1988. Now, what were the things that Basel One basically wanted to address? The first was the debt crisis in the banking sector, the need for convergence in measurement of capital adequacy. Like I mentioned, capital adequacy is looking at the total capital you have divided by your risk-weighted assets in terms of your credit, market, and operational risk. Now there's a convergence, but prior to Basel One, there was no convergence. A need for a broad consensus on weighted approach. That was what Basel One tried to address. Now, for Basel Two, that was issued in 2006, what Basel II that was issued in 2006 tried to address was the improvement in the way regulatory capital requirements. Now, the first to say was, look, let's have a convergence, which is Basel One. The two, they now improved on the regulatory capital requirements. They now improved on risk measurement and control. Then development of standard rules set in Basel that reflected underlying risk. So that was what Basel II was issued to address, which was in 2006. Just to mention that in most of the West African countries, what we have obtainable, based on my experience so far, is the fact that we are still doing Basel II and Basel III. I'm not aware of any African country that has implemented Basel IV in West Africa. Even for some West African countries, I am still aware that as of a year or 2 years ago, some of them just started implementation of Basel II. Because I was in one or two West African countries 2 years ago to assist with Basel II implementation. Their central bank just came out with some regulations guiding Basel. Now, Basel III addressed what were some of the issues that Basel III tried to address. So financial crisis with too much leverage on inadequate liquidity buffers. So Basel III, there were now liquidity buffers, you now had buffers because you could be well capitalized and but you will not be liquid. Having capital is different from being liquid. You may have long-term assets that cannot be easily converted to cash, and you have a lot of short-term obligations that are maturing. So what that implies is you have a lot of assets that are 2 to 3 years that you cannot easily convert to cash, but you have short-term obligations. I think the case in point is like the Lehman Brothers, where if they could have survived 2 to 3 days, the bank would not have folded. The bank would not have gone bankrupt. You can just check it out and look at Lehman Brothers. Even though they had enough capital, but they had liquidity issues. So these are some of the issues that she addressed, which is financial crisis with too much leverage, poor governance and risk management, and mispricing credit and liquidity risk, and that exceed credit quotes. So you had a lot of new interesting products. Basel III was issued to address that. Then you have Basel IV, which was issued after 2012. Now, Basel IV that was issued after 2012 was for increase in minimum capital requirements, even after several stress testing. And it's a good thing that Basel IV was released, because what we've seen is that I don't know how to phrase this, since the emergence of COVID, a lot of banks' capital have gone through several stress testing, because COVID-19 is a pandemic and a phenomenon that our current generation has not witnessed. So even in the face of globalization and the face of how it works, we needed to relook a lot of things. And as such, the capital of bank has been needs to be seriously stressed. That's one of the things that Basel IV addresses. But I'm sure there will be I'm aware that there are ongoing conversations for a Basel V, but currently what we have is Basel IV. And from my experience in Nigeria and other West African countries, where we are is Basel II, Basel III. Even some countries in Africa are just still at Basel II. So this talks about the scope of Basel I. I've given a snapshot of it. So this talks about the major scope of work set out in Basel I is the minimum capital requirement. Basel I was just like the minimum capital requirement is 8%. As long as you meet that minimum capital rate 8%, the bank should be fine. That was basically what Basel I addressed. Now for Basel II, it became, they had to sit down and we look at it and say, look, even though we are talking about minimum capital requirements, in terms of the capital framework, we should be looking at three pillars. So Basel II was based on three basic pillars: Pillar 1, Pillar 2, and Pillar 3. The Pillar 1 talks about the minimum capital requirement. So I'm sure if anybody makes reference to Basel II, you normally hear the three pillars. Now, what the pillar one talks about is approaches to credit risk measurement, approaches to market risk measurement, and approaches to operational risk measurement. Like I mentioned, pillar one, like I mentioned, Basel one just talked about what should be my capital adequacy ratio. As long as my ratio exceeds 8%, then your bank is fine. Now, pillar two takes a deep dive to say, how should I calculate my capital adequacy ratio? So it talks about capital adequacy ratio being your capital all over your risk-weighted asset for your capital market and operational risks, and gives guidelines in how to calculate your credit risk measurement, market risk measurement, and operational risk measurement. Now, Basel 2 talks about the supervisory review of an institution's capital adequacy and internal assessment process, which is typically called the ICAP process, Internal Capital Adequacy and Assessment process. It talks about the supervisory review process and the process of capital adequacy assessment. Now, for pillar 3, it talks about the effective use of disclosure, which is saying your disclosure requirements. So your pillar 3, you will notice in the financials of any bank, you will notice that for your disclosure requirements, they have to disclose their capital adequacy ratio, the measurement, the way they've computed their capital market and operational risk measurement. You will see a note in the financial statements. There's just check any financial institutions, you would see that note. It is standard. A section of the note must be note to the account, must be dedicated to reporting your capital adequacy ratio and the measurement, the way it has been measured. So that was one of the things that Basel II brought into play. So for Basel III, what Basel III just did is to build on Basel II, in the sense that now for Basel III is still in effect, but what Basel III has done is to say, even though you have your regulatory capital, it now brings in more buffer. You have your capital conservation buffer, counter-cyclical capital buffer, higher common equity tier 1, and minimum total capital ratio. It now says, even though you have regulatory capital, what is the quality of your regulatory capital? It breaks it down into your minimum total capital ratio. So it says, what is the quality of your regulatory ratio? It also talks about liquidity requirement to say your liquidity coverage ratio and net stable funding ratio. Like I mentioned that even though you are adequately capitalized, you may not be liquid. Case in point, the Lehman Brothers, what happened in terms of their bankruptcy. Then for leverage ratio, it introduces a minimum leverage ratio. It says, how much can I leverage my debts and assets? How much can I leverage of my balance sheet? So there's a leverage ratio. Now, the scope of Basel IV, which is like the finalized result. For Basel IV, like I mentioned, in terms of the West African countries, we are not there yet. Even though it was issued in 2010, I'm not aware that any African country right now. So the question here is, what risk? So you can use the chat box, you can tick on it. So what risk is material and non-material based on the Basel regulations? What are the risks if you look at a financial institution that you think is material and non-material? Please use the chat box. Just type the risks you think that is material and non-material. So what are the risks that are material and non-material? Any comments? Please use the chat box. So just to state, because of time, credit risk is material. Market risk is material. Credit risk is material. Market risk is material. Liquidity risk, like I mentioned, is material. Operational risk is material. Interest rate risk is material. But there's no risk that is not immaterial in some way. But just to state that you have some key material risks such as credit risk, market risk, liquidity risk, interest rate risk, operational risk, reputational risk, yes, group country risks, and all. The credit risk is the risk of default. It's the risk that you borrow someone money and the person does not pay you back. Your market risk is the risk of change, fluctuations in market rates, meaning foreign exchange rates or interest rates. That's your market risk. Your operational risk is the risk of loss due to a failure or in a process or a failure in one of your controls, which is your operational risk. Why your interest rates in the banking books is fluctuation in interest rates based on Tobacco, mute. While your group and country risk is the risk of your group or that particular country you're operating in. Okay. And the last, so this is the question. These are the material risk and the non-material risk. The material risk is credit risk, market risk, operational risk, concentration risk, business risk, reputational risk, interest rate risk, banking risk, group country risk, liquidity risk, model risk. While you have your non-material risk. The question here is the which is interesting. This is the answer. This tick was not meant to be there, but which of the following is not a Basel pillar one risk? The one that is not a Basel one pillar risk is liquidity risk. The Basel one pillar risk is credit risk, market risk, and operational risk. So there's a question which I'm going to answer to say that the question is in French. My question is to know what is the place of cryptocurrencies in banking activities. Nigeria's bank is banned from using cryptocurrency. Does this pose a risk? For the issue of cryptocurrency, there has been a very huge debate around if Nigeria should ban cryptocurrency or not. Just to state that currently in Nigeria, you are not allowed to deal in cryptocurrencies as a bank in Nigeria. Before the ban, what happened is we had some fintech companies where you could transact and buy your cryptocurrency, pay to a bank account, and you would credit your wallet. But what we had is that after the circular that has been issued by the CBN in Nigeria, banks are not allowed to do that transaction. Does this pose a risk? Yes, cryptocurrency poses a risk in terms of money laundering. So there's supposed to be a lot of risk to money laundering. So that's the risk it poses in terms of money laundering. So you are saying, does Basel have standards? So I'm taking the question from Bubakar. Bubakar. Sorry if I mispronounce your name. Bubakar Dikete, Mr. Bubakar Dikete. To say, does Basel have standards for hedging credit-related risk, covering both financial provision and actual security of tangible property? Basel does not talk about, Basel just sets a framework for measuring your risk. So in terms of your credit-related risks and hedging, Basel does not set um, standard. It just shows you how to measure it. What set a standard for hedging credit risk is IFRS. It is the International Financial Reporting Standard that guides in setting accounting standards for hedge accounting. The accounting standard for hedge accounting is either using IFRS 9 or using IFRS 39, or IAS 39. So in terms of credit-related risks covering this, what sets the standard is IFRS, not Basel. Basel is just for you to measure and quantify your risk in that particular. So I think I've answered all the questions. We'll still have a Q&A session at the end where you can still ask more questions. So thank you very much. I would allow my colleague, Mr. James, to take over. So we're going to go on a short break by 11. So after our break by 11, by 11:30 we will be back, and my colleague, Mr. James, will take over.
Okay, thank you very much, Mr. Eniola, for the two sessions that were so engaging and enlightening. To many of us, we are coming in contact for the first time with such terminologies. So we thank you once again, and we also thank our participants for being with us at the beginning of the two sessions. At this moment, we are going to take a pause and go for a 30-minute break. Then hopefully we'll come back and continue with what we have in the agenda. So thank you very much. Enjoy yourself. See you after 30 minutes.
Just to state, there's a question from someone from Adeboye Sunday. So he said, within Nigerian context, is this Basel regulation not yet incorporated into the CBN prudential guideline from banks and other financial reporting institutions? Yes, CBN has incorporated Basel II under a guideline. There's a guideline, a reporting guideline for reporting. So yes, CBN has incorporated Basel III. I hope that answers your question.
Thank you very much. Thank you very much. So see you after 30 minutes. Enjoy yourself. Thank you. Good morning, participants and our facilitators. I welcome you back from our 30-minute break. It is 11:30 now by our clock here. And we are going straight to the next segment of our training, which is Module 3, Key Accounting Provisions and Requirements, Relevant Standards, the AIS and the IFRS, that's the International Accounting Standards, and the International Financial Reporting Standards. And our facilitator is Mr. James Kakula, who has a very deep knowledge and understanding of these areas. And I invite you to listen keenly to him while he takes us through. Mr. James, the floor is yours. Thank you.
All right, thank you, Mr. Fassa. Good morning, everyone, and welcome to this session. I'll be taking you through the key accounting provisions and relevant standards as it relates to the financial services industry. You already said that this industry is the most regulated industry in any economy. And the reason is basically one, that the products and services that are traded in this industry, they are very complex. They range from a simple, say, loan for a commercial bank to some complex financial derivatives like options and swaps and all those kind of complexity that involves in accounting and evaluation of those financial contracts. So because of this highly regulated nature of the industry, the accounting provisions as it relates to this industry are also among the most complex, if not the most complex, in accounting standard as issued by the International Accounting Standard Board or the International Financial Reporting standards. So we have our brief outline. There are two key issues, accounting by financial services. So what are the key accounting underlying mechanisms and provisions as required by the accounting standards, and those relevant accounting standards as it relates to financial services, particularly for commercial banks and our insurance industry. Then we have a brief question and answer at the end. So, like Inula said, the financial services are very complicated because one, the products and services are intangible assets, financial assets. And of course, because of the risk associated with these products and services, just as we discussed in a previous lecture, market risk, liquidity risk, regulatory risk, and also volatility risk. And these risks are serious elements or considerations in the valuation and accounting for these products and services. So again, we learned that there are regulators in this industry, commercial banks, security and exchange commissions, insurance commissions that provide oversight, both for firms and individuals that are operating in this industry. And the reason is basically to protect the public interest, one, and two, like we said, the highly complex nature of the services and products that are traded in this industry. So to protect the public, there are regulators that supervise or provide oversight over these firms or individuals that trade financial securities in this industry. And again, from the private sector accounting side, there are a series of accounting and financial reporting standards that are required for the recognition, the measurement, and the presentation of financial instruments. We call them financial instruments because they are contractual rights or obligations that provide either for the receipt or the delivery of financial assets or the settlement of financial liabilities. So the products and services that are traded in this industry are very unique because one, they are intangible assets, all right? They don't have physical existence. And by that, the conceptual understanding of them require a deeper understanding of accounting and financial theories. So in accounting for these services or products, you have to understand where each standard applies into specific cases, as well for auditors. And the best auditor, financial auditor, is one who understands the accounting standards as it relates to the services or the organization he or she is conducting an audit of. So the individuals and firms that operate in this industry as it relates to both banking and insurance, they are required to recognize, say, for example, financial asset. All right. Financial asset is basically a contractual right to receive cash or other financial asset from another party, and also a financial liability. All right, the right to, the obligation to pay other cash or other financial asset to another party. So these assets or liabilities are to be recognized, classified as other asset or liability, and measured. In terms of measurement, we talk about either a cost or a fair value, and their presentation in the financial statement that should be in accordance with the relevant accounting standards. So as auditors or analysts, we are required to verify in terms of through audit or through review of financial statement to determine or to ascertain whether the various actors, the firms and individuals that are operating in this industry have accounted for these products and services in accordance with recognized financial reporting standards. So if I'm going too fast, if I'm reading too fast, or maybe my explanation is not very clear or audible, please you can raise your hand, or you can stop me, then I can otherwise repeat or provide more detailed explanation and clarity to your concern.
Yeah, thank you very much, Mr. James. You are doing well for now.
Okay,
Let's
so,
continue.
all right, good. All right, so the relevant accounting standards. Now, accounting standards are basically rules of best practice as it relates to financial reporting, and they apply to the recognition, the measurement, and the presentation of elements of the financial statements. So firms that are operating in the financial services industry are required to specifically recognize, classify, and measure those services or products, and as well as present them in terms of financial statements as per clearly defined guidelines per accounting standard issued by the International Accounting Standard Board. So the key standard we're looking at here, there are a few of them here, even though there are other relevant standards that are not directly applicable, say where in specific case they apply. So we'll just look at these ones that are directly applicable to both the traditional financial services sector, like the commercial banks or investment banks or private equity and stuff like that. And then we look at also insurance as it relates to claims and assets and losses on those financial contracts. So the first standard here is the International Accounting Standard 32, which refers to the presentation of financial instruments. Now, we say financial instruments are basically a contractual right or obligation either to receive or to pay a financial asset. That's basically financial instrument. So they give one party the right to receive a certain percentage of the net asset of another party, or to pay certain percentage of their net asset to the other party where the party is the entity is the party to that particular contract. Then we have insurance contracts, which is the first project of the International Accounting Standard Board, which is in two parts. We have IFRS 4 and IFRS 17. So the first part of the project was for the committee for the standard setting to determine what qualifies first and foremost as insurance contract, what are the elements of an insurance contract, and how it is initiated, how it is subsequently recognized, and how claims by the insurers or insure the insurer liability thereof on a particular contract. And these are relevant provisions that apply generally, but they are specific that we'll go through as we go along. Then we have IFRS 7, which is disclosure. So disclosure comes about because of the need for the users of the financial statements to have an understanding of the nature of the financial instruments, which is an asset or a liability or an equity interest, so as to provide a further understanding that will not be presented on the face of the financial statement, either the face of the statement of financial position or the statement of profit and loss. So this standard is required to provide additional understanding in terms of notes to the financial statement, in terms of the specific risk that are associated with these financial instruments. Then, of course, IFRS now, which is a major standard, supersedes IAS 39. So this talks about the first what qualifies as a financial instrument in terms of classification as asset or liability, and then also whether you can classify into what through profit and loss or through other comprehensive income. Now, I brought this IFRS 13 because most of the products and services that are traded in this industry are basically traded at fair value. So it's important to have an understanding of what it means to value an asset or a liability at fair value and what's the fair value measurement. And then, of course, the second part to the insurance contract is to determine the contractual obligation of the insurer to the insured, and also how to determine the discount rate on the future cash flow, either to or by the insurer. So, okay, now IAS 32, which is a financial statement presentation, is basically on the determination of financial asset or financial liability, how to classify them in the financial statement. That is first and foremost, both at initial recognition. Now, initial recognition means the date of the entry into the contract between the parties to the financial transaction. Take, for example, if a commercial bank, all right, lends to maybe an organization or to an individual, all right, and the terms of the contract, all right, so how is the commercial bank going to recognize that particular transaction as a loan portfolio and the associated cost in terms of transaction cost? Now, when it comes to the presentation of a real statement, the standard is very clear between what qualifies as an asset. A financial instrument is only an asset when there's a contractual right to receive cash or other financial asset from a third party. So if there's no consideration to be received or receivable, that does not qualify an asset. We know that asset is a resource that has probable economic benefit. So that also applies to financial instruments. So a financial instrument is only recognized as an asset if and only if the entity has a contractual right to receive or an asset, which is cash or other financial asset. And of course, liability. So the standard also requires an entity to recognize a transaction as a liability if and only if it has a contractual obligation to pay cash or other financial asset to another party. Then also in terms of dividend, interest, losses, and gains on those transactions. Now, that will be done separately in IFRS 9. But also here, in terms of the presentation, it also applies to those elements that go into the statement of profit and loss. But specifically, IAS 32 also provides the requirement or the condition under which an entity can offset its liability against an asset. And that is only done when there's a contractual right to do so. Otherwise, you have to report each financial asset or liability as gross on the face of the financial statement. And this statement also here, the presentation, like we said, interest, dividend, losses, and gain as income or expense in the profit and loss statement. So, for example, there are three recognition methods, our initial recognition. So, if our initial recognition, the entity or individual intends to just trade in the financial instrument, then the standard says that that instrument should be recognized initially at fair value through profit and loss. So what does that mean? Fair value means the value of the transaction between two independent parties and at a given date. Now, that valuation can be somehow subjective if there's no recognized market for that particular transaction. Say, for example, how do you do shorts in the case of private individuals that are not listed on any organized or exchanges or over-the-counter exchanges? But we'll deal with those later on in the presentation. Then another key player in the industry is the insurance company. So those are organizations that provide risk protection either for death or for property. But then basically the standard is intended to prescribe the relevant requirement in terms of recognition and measurement of the items. Now, there are several items in every insurance contract. One is the asset. Now, our initial entry into the contract, say if an insurer receives cash from an insurer, how does that cash, that asset, how does it recognize, how is this be recognized? So in the case of the standard, you have to recognize a liability because that amount received or receivable from the insured party is a claim for future benefit. And because of some associated uncertainty with respect to the occurrence or no occurrence of future events that are not within the control of the entity, that amount should be reported as a liability. So there's a debit to cash and credit to insurance or insurance payable or claims payable, whatever nomenclature that the entity decides to use. Also liabilities. Now, provision for liability, those are complex valuation questions in terms of how to predict what's going to happen in the future. But those are estimates that can be made based on the prevailing market conditions and also service requirements. So if the service requirement is just that the insured party is required only to provide a preponderance of evidence for any damage claim, that will affect how liability will be recognized or even income and gain on the transaction. So in terms of disclosure, insured party are basically insurers are basically required to disclose asset, liability, income, and expenses in accordance with the actual contractual obligation or provisions of the contract. So if the contract provides for time premium, say the premium expires with the passage of time, then the insurer has to recognize the the associated revenue or gain on a transaction based on the passage of time, or it could be some contingent event that will occur or not occur in the future. So in that instance, you have to use an annuity or other valuation technique or mechanism to determine the liability, asset, or income thereof on that transaction. Then finally, under IFRS 4, there's a major provision is the condition under which a liability can be redesignated as an asset. Now, a liability we say is an obligation to pay cash or other financial asset to a third party, in this case, the insured party. So there are conditions or there are instances where, because certain provision of the agreement has come to fruition, the insurer is allowed to reclassify financial liability that was initially recognized as obligation now as an asset which is a receivable or has already been received by the insurer. So there are conditions provided by the standard IFRS 4 under which an insurer can recognize a liability or previously recognized and then reclassify them as or redesignate as a financial asset. So now we talk about disclosure. Disclosure, like we said in the introduction, is basically to state in a financial statement the nature of the financial instruments in terms of asset and liability or equity interest, and the associated risk. And the reason for additional disclosure is that on the face of the statement of financial position, there will be no explanation regarding the associated risk, say the market risk or the credit risk or even regulatory risk. So if there's any event that poses a significant threat to the realization of either the benefit or the payment thereof, then it has to disclose those information in what we call the notes to the financial statement. And also offsetting. So on the face of the financial statement, maybe there's a single line reported as say debt, all right, which is a financial liability. But then that debt is a net of some asset and some liability. So you have to report in the notes of the financial statement how that net amount was determined and under what condition that gave you the right as a reporting entity to report that amount of asset or liability as net. So also credit losses, especially for commercial banks. You will know that commercial banks are regulated by also central banks. And here, there's a serious conflict between regulatory bodies and standard setter because, for example, in the case of commercial banks, they are required by the central bank or the relevant regulatory authority to provide for losses, future losses, even at initial recognition of these instruments. So if, say, a party gives or receives a loan from the bank, as per the central bank prudential regulation, there's certain percentage of estimated probable future loss that should be recognized on that asset. But we know in accounting that is completely unacceptable. So there comes a serious conflict between what the regulatory requirements are and what the accounting standards say. But for tax purposes, the accounting standard supersedes mostly in terms of the initial recognition of the asset, because our initial recognition there have been no contractual obligations that have been performed by other parties. So no party has defaulted, no party has performed their side of their obligation. So accounting-wise, there have been no impairment, there have been no losses on those. So for credit losses, in terms of for commercial bank, they are required to say classify their portfolio into current, non-current, standard, or default or lost. So all those categories come with a specific provision in terms of the percentage of the amount that should be recognized immediately as loss on the financial asset. But accounting-wise, the standard requires that there should be an impairment test to see whether market valuation. So take for example, if an individual bought a share in an entity which is a fair value. Now, fair value means the value of the shares in that investee on the market. So if the value of that share has changed either upward or downward from the date of acquisition to the reporting date, then the reporting entity has to either recognize a loss based on the fact that the value of that share has reduced, or a gain based on the fact that the value of that share has increased. And that value can be reported either in profit and loss if that amount of variable interest is held only for trading purposes, meaning there's no intent by the holder of the transaction or the contract for a future, for long-term or future benefit, other benefit, maybe dividend payment or what have you. It's only for trading purposes. So the standard requires that that amount be reported through profit and loss. Now, at initial recognition, we said because that amount is reported at fair value through profit and loss, every transaction cost incurred in the acquisition of that contract or that service has to be directly expensed at initial recognition. So IFRS also provide a requirement for the disclosure of the nature, say the liquidity of the instrument, how liquid it is. They say short-term liquidity or long-term liquidity, and the market risk. And you know that says regular market risk has to do with the exchange rate risk and the interest rate risk. So the volatility in the exchange rate and the interest rate will also affect the value of the transaction, because these transactions are traded at fair value, and fair value is a determinant of the effective market interest rate at a given time as it relates to a particular financial instrument, either a financial liability or a financial asset. So, so in terms of disclosure, we say you have to disclose or either as an asset or a liability, and the condition under which you can classify those instruments as either an asset or a liability. An asset it is because there's a contractual right to receive cash or other financial asset from a party. And if it is a liability, you have the obligation to deliver cash or other financial liability, financial asset. So IFRS 9 is a replacement of IAS 39. IAS 39 was actually financial statement presentation, recognition and measurement. IAS 39, that was the nomenclature of IAS 39, which was the recognition and measurement of financial instruments. Now, so there's a higher modification of that standard because there was some limitation in terms of, especially for subsequent recognition of financial instruments like embedded derivatives. Now, what are embedded derivatives? So there are times where a particular transaction can give rise to other elements of the financial statement. For example, if you take a loan, and the loan that was granted by the commercial bank to you is given to you at a rate lower than the market rate, the effective rate, in essence, you have earned an income as an equity interest, because that amount that has been given to you lower than the market rate, you are effectively recognized an equity component, because the debt will be less than the face value of the obligation that you are going to recognize in your financial statement. Also, IFRS 9 talks about the hedge accounting, and hedge accounting is basically the protection of cash flow, to protect your cash flow against losses that are due to volatility or uncertainty associated with the particular element of the contract. So there are basically three kinds of hedge accounting. So one is, for example, if your shares that you bought in the entity or in whatever organization is traded at fair value, and that fair value is uncertain in terms of the volatility of the market demand and supply in our shares, because price is determined basically by the demand and supply of the shares. Now, if there's a risk of either upward or downward movement, as an individual or as a party, you can ensure or you can protect against the movement or adverse movement. And that is basically what we call fair value hedging or fair value. Now, fair value because the amount is presented or is carried at the value that is recognized on the market, if there's any available market. Then there's also a cash flow hedge. A cash flow hedge comes about if, for example, you are in receipt of a foreign currency, all right, or you have obligation to pay a foreign currency debt. So what you can do in essence, you can take a protection to avoid an adverse movement in the exchange rate between your reporting currency or your functional currency and that of the foreign currency, and that will be a cash flow hedge. So you can hedge against an adverse movement in the exchange rate that will apply to a cash flow hedge. Or there could also be a hedge of a foreign operation. So most organizations, especially for investment banks, they buy variable interest in different organizations in different countries. And the purpose is for diversification, because it is highly risky to put all of your money into a single investment. All right. Otherwise, if that particular entity defaults or fails, you're going to lose all your money. And because of that, most organizations or even individual or brokers or fund managers, they invest into foreign asset, and that foreign asset will be traded in a foreign country on a foreign jurisdiction, and there's a high risk of, say, default or some liquidity risk and all that kind of stuff. So you can also protect yourself by hedging that foreign operation. So IFRS now also provide conditions under which the income, the loss, and the asset thereof can be recognized in that particular foreign investment. So now, one key provision of accounting requirement also in IFRS 9 is the recognition that we said, the recognition of credit losses or interest income. Now, let's talk about first credit losses. Now, credit losses has to do with basically the failure of the debtor to pay back the credit. All right. So, under what conditions those should be recognized? Now, basically, the standard says that if there be sufficient information or sufficient available conditions to provide certainty that this particular individual or area is unable to pay back this loan or to deliver this particular financial instrument, then the holder of that instrument is required to recognize credit losses. And the credit losses will be to the extent of the anticipated default. Also, the standard requires in terms of the income. Now, the profit or say the gain on fair value, all right, if that instrument is held to maturity instrument, meaning the holder, the one who's going to receive the cash or other financial asset, has an intent to hold that particular financial asset up to maturity, then whatever gain or loss on that particular financial instrument should be recognized in other comprehensive income. Now, for tax purposes or even for accounting purposes, these are not actual gains. These are just paper gains that result as a result of the fair value measurement, because fair value measurement is an accounting concept that is not actual. It's just a way of providing for the possibility of loss or the possibility of gain. But the actual gain or the actual loss will be recognized when a transaction has been executed, meaning when there's a delivery or there's a receipt of the financial instrument, which is either an asset or a liability. So, or the sale on the open market. So if the value of the asset has reduced and it's a publicly traded asset, then you recognize a provision which is based on your intent. Because you're going to hold that instrument to maturity, you have to recognize the gain or the loss through other comprehensive income. Now, at the date of, say, delivery or maturity, then the actual gain on a particular financial transaction, of course, the gain and losses will be a fluctuation in the value of the investment. All right. Now, if the actual gain on a transaction in terms of the sale is more, of course, you can net off the gain and the previous losses recognized through profit and loss. The standard requires that you can also net off gains and loss previously recognized on a financial instrument. Of course, so the destination of financial asset, there are variable requirements in terms of options that are available to the holder of the financial asset or liability to the destination as either an asset through fair value, profit and loss, or through fair value, other comprehensive income. Now, the basic distinction between the two is for fair value through profit and loss, the holder of the transaction has no intent to hold the transaction up to maturity. So basically it's for trading purposes, is to what we call speculation. And speculation is what traders do on the financial market. So they speculate, say this financial instrument is going to be a share or a bond, it's going to go up. So they will invest in our bond. Now, the intent is not to hold our bond to maturity. In fact, most of those bonds, the call perpetual bonds, or of course, shares are not meant to be redeemed. So even if you borrow that variable interest, the fact that you are not holding it to maturity as per the contractual agreement, you have to recognize any gain or loss that will occur at the reporting date through profit and loss. So that is a default position. The other condition is if there's an intent to hold that financial instrument up to maturity, then the standard requires that you have to recognize the gain or loss in other comprehensive income. All right, that means they will not go directly through the profit and loss statement. They will go into other comprehensive income. And we know the items that go into that statement is, for example, revaluation gains on property, plant, and equipment, or revaluation loss on property, plant, and equipment. So they go there because they are other comprehensive income. They don't relate directly to the core operation that are presented in the profit and loss statement. Then the third one is recognized at amortized cost. Amortized cost being the effective cost less any loss or associated, maybe other loss or associated gain. Now, take for example, the most basic financial asset would be a receivable. All right. If a supplier, a customer bought an item, all right, from an organization, that creates a financial asset for the seller. So the seller, there will be a terms and condition for the payment of that receivable. Now, because the seller of that goods or product is going to hold that, is going to wait until the date of payment, or what we call the maturity, and there's an effective cash flow that's going to occur on that date, you have to recognize that particular instrument as amortized cost. And amortized cost will be that amount less any associated, maybe in the case of a receivable, well, a bad debt that will result in case of a default on a particular transaction. So IFRS 13 is not directly a requirement for financial services industry, but because of the nature, all right, of the transaction, they are basically measured at fair value. So fair value becomes a key element in the accounting for these transactions. So fair value, basically, like we said, is a value that you pay to settle a liability or you receive to acquire an asset in orderly delivery of the transaction between two independent parties. So in case of, say, we said loan portfolio, all right? The loan portfolio that the bank has, the fair value will basically be the value of the transaction as initial recognition. Now, subsequent value will be either a reduction due to credit losses or a provisional gain that will be recognized in the case of that loan because it's held to maturity. It will be recognized in other comprehensive income. All right, so fair value play